Investing wisely is crucial for building wealth and achieving financial goals. While there's no single best way to invest, a diversified approach that considers your risk tolerance, time horizon, and financial objectives is key. Here are 5 highly effective and common investment strategies. 1. Diversified index funds and ETFs. What they are? Index funds and exchange-traded funds, ETFs, are popular investment vehicles that pool money from many investors to buy a basket of securities, such as stocks or bonds, that track a specific market index, e.g. S&P 500. Why they're great? They offer instant diversification, meaning your investment is spread across many companies or assets, reducing the risk associated with any single investment. They typically have low fees and are considered a buy and hold strategy, making them excellent for long-term growth and suitable for beginners. How to invest? You can invest in index funds through mutual fund companies or ETFs through brokerage accounts. 2. Real estate, direct or REITs. What it is? Real estate investing can involve directly purchasing physical properties to rent out, rental income, or sell for profit, capital appreciation. Alternatively, you can invest in real estate investment trusts, REITs, which are companies that own, operate or finance income-producing real estate across a range of property sectors. Why it's great? Real estate can provide both passive income from rent and potential for long-term appreciation. Real estate offer a way to invest in real estate without the complexities of direct property ownership, providing liquidity and diversification. How to invest? For direct real estate, you'll need significant capital and be prepared for landlord responsibilities. For REITs, you can buy shares through a brokerage account, similar to stocks. 3. Dividend stocks. What they are? These are stocks of companies that regularly pay out a portion of their earnings to shareholders in the form of dividends. Why they're great? Dividend stocks provide a steady stream of passive income, which can be reinvested to compound returns or used for living expenses. They often come from established, financially stable companies, offering a degree of stability compared to more volatile growth stocks. How to invest? You can purchase individual dividend stocks through a brokerage account. Researching companies with a history of consistent dividend payments is advisable. 4. Bonds. What they are? When you buy a bond, you're essentially lending money to a government, municipality, or corporation. In return, they agree to pay you a specified interest rate over a set period, and then repay your principal at maturity. Why they're great? Bonds are generally considered less volatile than stocks, and can provide a predictable stream of income. They are a good way to diversify a portfolio and can act as a cushion during stock market downturns. How to invest? You can buy individual bonds or invest in bond funds, mutual funds or ETFs that hold a portfolio of bonds through a brokerage account. Government bonds, like US Treasuries, are considered among the safest investments. 5. High-yield savings accounts, HYSAs, and certificates of deposit, CDs. What they are? HYSAs are savings accounts that offer a higher interest rate than traditional savings accounts. CDs are time deposits, where you agree to keep your money deposited for a fixed period in exchange for a fixed interest rate. Why they're great? These are low-risk options for preserving capital and earning a modest guaranteed return. They are ideal for emergency funds, short-term savings goals, or for conservative investors who prioritize safety over high returns. How to invest? You can open HYSAs and CDs directly with banks or credit unions. Important considerations for investing. Risk tolerance. Understand how much risk you are comfortable taking. Higher potential returns often come with higher risk. Time horizon. How long do you plan to invest? Long-term investments, 5+ years, generally allow you to ride out market fluctuations. Diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes, industries, and geographies. Fees. Be aware of the fees associated with your investments, as they can significantly impact your long-term returns. Financial goals. Define what you're investing for, e.g., retirement, down payment, education, to help guide your strategy. Consistency. Regular contributions, even small ones, can compound over time and significantly boost your wealth. Before making any investment decisions, it's always a good idea to consult with a qualified financial advisor who can help you create a personalized investment plan based on your individual circumstances.